Hello and welcome to Peaceful Investors. In this video, we shall discuss what is dollar cost averaging or systematic investment plan and what is lump sum investing. When can we use each of these methods of investing and how to use each or both of these methods for your benefit. Most often, these are the terms used when you invest in mutual funds. However, this is applicable for any kind of investment that you're looking for. Before we start, let me ask you something. Imagine this. You invested 5 lakh in the market yesterday and today the market fell by 5%. Just imagine. Now how would you feel? Do you have a feel of regret? Do you feel the fear that market might correct further and you could see losses in your investments? Or would you panic and withdraw your investments? Well, a surprise question is, would you invest more because you have a better price, or would you freeze completely when there is a correction? These are challenges every investor faces. Today's video will answer one of the most important questions. What is dollar cost averaging versus what is a lump sum investing? Which is actually smarter or better, or most importantly, what suits you? Stay with me even if you know this. You might find some answers for your most pressing questions when it comes to investing. In this video, we are not going to talk about just theory of definitions. We are going to use real behaviors, real examples, and practical experiences in the market volatility. We will also see how psychology and behavior plays a role in your investment decisions. Stay till the end because you might realize what really suits you as an investor or a decision maker. Most investors don't lose money because markets crash. They lose money because of how they invest. Have you ever waited for the right time to invest? How do you know which is the right time? What is your definition of right time? Have you ever invested a big amount and then stopped checking your portfolio because you were confident about your investment? Think about this because your behavior is very important for wealth creation. Or worse, do you invest and keep checking every single day about what happened to your investment and that stresses you? The way you enter the market or start investing decides whether you will stay longer or you will quit as soon as possible. That's why understanding methods of investing or dollar cost averaging versus lump sum is more important than fund selection, especially when you are beginning to invest. For some of you, it may sound very logical or no brainer on what is the method you might want to implement, but stay with me. You might be surprised on certain things which might suit you and you're not aware of it. If you are a beginner who is listening to this video, let me quickly explain what this table means. First thing is, this table is explaining the concept of systematic investment plan, and that is what we call as dollar cost averaging or rupee cost averaging. In this particular section, I'll tell you how averaging works. So the first column is number of months that you will invest. Second one is amount invested every single month. Here in our case, we are investing 10,000 for 10 months. NAV is nothing but net asset value of a mutual fund. In short, it is the price that you pay for 1 unit of a fund. Let's say it is 100. This is an assumption. And if you invest 10,000 per month at the cost of 100 rupees per unit, you would be receiving 100 units for that particular month. So moving on to the second month, what's happening is you again invest 10,000, but now the price has increased to 110. Therefore, you're getting 91 units. Moving forward, third month, when you invest 10,000, if the price has fallen, you will get more number of units. Here in our case, at 90 rupees, you're getting 111 units. So once the price increases from 90 to 95 next month, you will get lesser units because it has been expensive for 5 rupees now. So you get 105 units. So when the prices fall, you get more number of units, and when the price increases, for example, 8th month here, The cost of one unit is 125 rupees. Therefore, the number of units you get for that month is 80 units. Like this, when we go on and on and on, let's say for 10 years, the price at which you buy is the ongoing price for that particular month. So let's say in a particular month, when the price has fallen to 75 per unit, when you started it was 100, you get extra number of units simply because you are still investing. But if anybody uses the intelligence of being in and out of an SIP, the compounding will not work. Simply because when the price increases from 75 to 100, your existing 133 units plus all other units you have accumulated from the past plus this month's unit, all of this will start getting the impact of increase in the price. Therefore, on an average, you would have paid a better price as compared to people who go in and out of the fund depending on the price, or those who try timing the market. So this is the concept of averaging price. Generally, globally it is known as dollar cost averaging for a regular investment like this. But since we are talking about Indian markets, you can say your average price overall will be better when you continue investing in an SIP mode. The name itself suggests systematic investment plan. Therefore, this system of investment regularly, irrespective of the market condition, will play in your favor in a long period of time. Looking at how lump sum works compared to the same systematic investment. So, over a period of 10 months, if you have invested 1 lakh, at an average price for the last 10 months, you would have got total number of units of 986 units because of price up and down. But in the beginning, if you had 1 lakh and you had invested at 100 rupees per unit, you would have got 1000 units. But while trying to time the market, if the lump sum happens to be invested at the highest price, when the market was at its highest price, the person would have got lesser number of units. So here is the game of what works, what doesn't work. So there are advantages and disadvantages of both. In an SIP mode, when you invest regularly irrespective of market condition because you believe in the economy and your selection of funds has been good, in those cases you will not have to time the market, you will not have to read the market because the fund manager does it for you when it comes to mutual fund, and also the stress of ups and downs will be less because you are consistently automating your SIPs. When it comes to lump sum, the person who wants to invest lump sum will have to know the markets, must be good in analyzing things, and also timing the market is not the best thing to do because even the best of the managers out there are struggling when it comes to timing the market. So those who invest and the fund managers who invest have data and information and intelligence. Therefore, they do it well. We don't have to get into those things as retail investors. But when should we do lump sum? Let's say you have got money from your ancestral property sale, or you have got a lump sum bonus, or you have a lump sum which is lying in the bank which you have not used for a long time and which you will not use for a few years later. Those are the times you can put, provided you are okay with the ups and downs of the market and you don't panic if the market goes against you for a short period of time. So if these are the conditions that you agree with, then lump sum also makes sense. As far as the mindset goes, if the lump sum is small or if the lump sum is manageable, you still won't panic. But if you have a huge amount like 15 lakh, 30 lakh or 50 lakh, I would still suggest to cut it into parts and invest regularly, not all at once, because the stress that will happen in case market gets into correction is not worth taking. So at any given point of time, please check your personal financial circumstances and only get into investment irrespective of who advises you or what the current market condition is. That way you can keep your stress levels down. Now that you have seen the example, you would have understood better. But there will always be a question of, but what if I invest at the wrong time? Most of you might have come across these questions. This fear alone stops most people from investing. There is nothing called wrong time or right time in the market. What really matters is how much risk are you ready to take, how long are you ready to invest or keep the amount invested wherever you have chosen to invest, and how soon do you need that investment back for a certain use. If there is a requirement for short term, it is advisable that you don't take very risky bets or investments. If you have a long time horizon, let's say more than 10 years, you can take a certain amount of risk. You can wait till the market corrects and goes back to bullish market. So when your time horizon is longer, your dollar cost averaging or the SIPs will generally work well. So, what's more important is time and risk rather than asking which is the right or the wrong time. But these are all well heard. Let's compare this with many scenarios or dimensions so that you understand that there are times that a lump sum may not work, but probably you are in a better position to take risk and therefore you want to stay invested. So there can be different scenarios. Let's put this into action and compare both of them in 4 different scenarios and see what suits you as an investor. The 4 different scenarios we want to compare is market timing versus discipline, how that affects our investment decisions. How about emotional impact when you do one of these, that is SIP or lump sum? What could be the return potential in both of these cases? Or the behavior reality, which means irrespective of what happens, how do you feel after investing? If it stresses you out, then you're not in the right place. So let's see each one of this and compare both the methods. The first dimension is market timing versus market discipline. In this case, if you have invested a lump sum, it works best if you have invested during market lows. If you are someone who has already experienced this or who knows how to read the market, and also if you're comfortable with volatility, then it suits you. But it requires timing. Timing, in a sense, it requires you to understand that that lump sum which you are putting is fine with you or you are comfortable putting that size of investment into the market. It's not about highs or lows, it's about timing your personal financial needs. In fact, if you are timing the market lows by any chance, then that's very challenging because even professional investment fund managers also struggle with this because there is nothing called perfect time. In spite of having first hand information about important historical numbers, data, influences, sentiments of the market, and 100 other things, the fund managers also advise not to time the market. Coming to SIP, you don't have to time or you don't have to read a lot of data. You already know that you will stay invested irrespective of ups and downs. You also invest over a period of time, so your average cost as it is going to give you the benefit of the price going down or the cost being less than what you had invested with. Therefore, you will get a better price when the market falls, and those units will also move further when the bullish market catches up with its trend. You must have heard this famous line, time in the market beats timing the market. But this makes sense only if you stay invested. Moving to the next scenario, you should see how the emotions impact decisions. If you invest lump sum, your portfolio volatility may feel intense because of the amount you have invested. If you have invested, let's say 15 lakh, and if the market corrects by 20%, you should be able to take that kind of risk. So, one bad month should not shake your confidence, and also there is a higher chance of panic exit if you're not prepared for these kind of scenarios even before you start investing. It all depends on how your emotions work when a scenario like this acts. And this definitely has to be planned because market has no guarantee or there is no fortune teller who says exactly what could happen next. In an SIP mode of investments, a small amount has been invested over a period of time regularly, which means it doesn't have major emotional stress even if there is a long correction in the market, which means it is easier to continue even during market crash. Therefore, the consistency and discipline makes a lot of sense when you invest in the mode of SIP. Also, your huge amount will be cut into small pieces, and your small SIPs month over month is not going to hurt you emotionally because you're not taking a high risk. This way, SIP protects you not from the market risk alone, but also from yourself, especially the emotional impact on a person. The next one is return potential. Most people run behind what is the maximum return I can get for a particular investment. In that attitude, if you invest lump sum, historically it has shown that it gives higher return if invested early in a rising market. Again, the condition says if you have invested in a time when the markets are in bullish mode or bullish trend, and in a rising market, if you have stayed invested, you will have a good return, but there is no guarantee. It also works best when the valuations are reasonable. If you are a person who love reading numbers and if you know how to do the valuation check, that's great. And also you can do this if you can take a little bit of risk and you're okay with that. But when it comes to systematic investment, you may slightly reduce the peak return. That is, you may get a little lesser return as compared to a huge sum, because a rising market would always give benefit for a lump sum investment also, but you wouldn't miss too much. It improves consistency and also you feel completed when it comes to your task of investing. But past performance does not guarantee future return. So please do not see some number, get excited, and jump into the investment. You will have to give yourself some time to understand how things work. Coming to behavior, which is the most important point here, in a lump sum investment, mostly based on discussion, recommendation, or fear of missing out, there will always be a risk of panic. You would have invested because of fear of missing out, or you would have invested with a lot of analysis and comfort level with risk. If it is with analysis and if you're comfortable with risk, then that's perfectly all right. But if you have invested with fear of missing out, I wouldn't say you should go to lump sum investing. When it comes to systematic investment, the compounding halts if you regularly keep going in and out of the investments. So, irregular investments will not allow compounding to work. If you stay invested, that's when the compounding works. So, compounding needs not just money, it also needs time to show you what could be a great return. Also, discipline is a system on which compounding works, and consistency is a personal choice. So, as much as we say you have to be consistently invested, if a person panics during market corrections, then it is a behavioral problem rather than a market issue. We all know market goes through cycles, so we should be ready for facing cycles and then know that we are investing for what reason and how long can we stay invested. So, most important skill in investing is behavior, which is belief system, which means you should know yourself and how you will react to each scenario. You also need patience. Sometimes, even in a bull market, you may not see good returns if the market is sideways. So, you need patience as well as consistent action. So, if you are a SIP investor and if you just remove your investments for 2 years, you may not see the effect of compounding or the cost average. To make it a little more clear, let's compare two people. Let's say Mr. A, the first investor, invested lump sum. He invested 6 lakh in January. The market fell or it went into correction and corrected 15% in February, which is possible. And then, out of panic, this person exits from the investment in March with a loss, assuming that the markets don't work, or stock market is risky, or mutual funds don't work. These kind of assumptions happen when the behavior is not apt. Probably this person did not calculate the risk or how long can he stay invested in the market. Compare this with investor B, who chose systematic investment plan, invested 50,000 per month up to 6 lakh. Market fell the second month, but still this person knows that this is a systematic investment, so continues to invest. Once the market recovers and moves upwards, he benefits fully because while he was investing and the market was correcting, he got more number of units, and when the market is back with this bullish trend, he got the benefit of both. So let's say after 5 to 7 years, investor B or people like investor B ends up wealthier because of consistency, not because of market return. Market was the same for both people, but the return was different because of behavior. Therefore, knowing ourselves, how we react, what size of investment is suitable for us, what is the amount I can let go for a month and month over month, or am I okay with taking risk in a lump sum and stay invested? These are the kind of questions one has to ask himself or herself and also observe over a period of time. If you are a new beginner or if you are a fresh investor in the market, you may not have realized all of this. But over a period of time, you would understand this better if you observe yourself. And whatever feels stressed out, maybe for 2 or 3 reasons, mainly because of lack of knowledge, which can be covered by upgrading yourself with financial knowledge, or if you are uncomfortable, you might seek a mentor or a financial advisor. But if you don't understand and still continue to fight with the market, I don't think that strategy works. You may still ask which is the smartest way of investing. In short, I would say choose lump sum if you have high risk tolerance, you can understand the market cycles, and you won't panic during market falls. But otherwise, it would be best to choose systematic investment plan, especially if you are a beginner, if you want peace of mind, if you are a busy working professional, and you value discipline over excitement. Most retail investors should start with the systematic investment plan and later combine it with smart lump sum investments depending on personal choices and also market conditions. A hybrid method or smarter strategy would be your core portfolio, which is for your long term portfolio or long term investment plans, should generally run on systematic investments. Any extra money or bonus or inheritance which you might have could be invested during market corrections if you know how to read the market, because timing becomes important when you are putting a lump sum investment. Also, as per long term goal, you should stay invested. This hybrid approach reduces the regrets of missing an opportunity. It builds confidence in you, and also you will know how far you are when it comes to risk taking, and also improves your long term wealth behavior. You might as well learn how to take advantage of market correction and put some lump sum which you are ready to risk over a period of time. But after having said all this, I would still say the best strategy is the one you can stick to over a long period of time without being stressed. Do you think this kind of learning helps? If this video has been helpful, I would request you to please like, share, and subscribe. That way, it will encourage me to do more videos like this. Also, I would like you to tell me what are the other concepts or topic you would like a video on. I would be more than happy to help you out. It was so much fun being with you, and I would love to have you in our community. Please remember to subscribe to our channel. Thank you so much for your time. If you have stayed so far, I really appreciate your time, and I'm grateful that you could be here till now. Signing off from Peaceful Investors. Thank you.